What's up, guys? Stacy here from Becoming Financially Fit. Today we're going to talk about everything you need to know about credit cards. Let's get into it. Before we get started, I make videos about personal finance, financial literacy, savings, and investing. So if you're interested in any of those topics, make sure you go ahead and subscribe to the channel now to stay updated. Also, make sure you hit the bell notification to get an update every time I post new content. Okay, let's get into it. So, credit cards are great ways to build credit and get discounts. But do you know what they really are? At the most basic level, a credit card is a short-term loan provided by a bank or a financial institution. The three most common types of credit cards include standard credit cards, secured credit cards, and charge cards. Standard credit cards give borrowers a set credit limit, a variable interest rate, and a minimum payment that's due in full every month. With standard credit cards, consumers can spread out the balance and the repayment period over a longer course of time, which enables them to make those minimum payments and spread out those purchases over a longer period of time. This is one of the pros of having a standard credit card, but this is also a con because the longer you actually hold a balance on that particular credit card, the more interest you're going to have to pay in the long run. The next type of credit card on the list is a charge card. Charge cards have no limit, but they must be paid back in full every single month. It doesn't matter what the balance is or how much you spent for that particular month. Since the balance is due in full every month for charge cards, there's no set APR or interest rate that you have to pay. So one of the good things is you'll never have to pay interest, but also one of the bad things is you're pretty much just paying it off in full every month. So it's equivalent to using cash essentially. And last but not least, the third type of credit card is a secured card. Secured cards are mainly geared towards individuals with not so stellar credit or individuals that haven't established credit thus far. This option requires borrowers to actually put down a set down payment, let's say $500, in order to actually get that credit card and start spending that money. The thing about secured cards that a lot of people don't understand is that you're actually paying money up front to spend your own money. So let's say I put down a down payment of $5,000, my credit limit will be $5,000. So essentially I'm using my own money and I'm actually paying the company to allow me to use my own money. So I would definitely not recommend a secure card unless you're actually starting to initially build credit or you're trying to get your credit rebuilt, because you should never have to pay someone else to use your money. So now that we've talked about the three types of credit cards, let's get into some of the credit basics that goes into these credit cards. So this part of the video is going to be specifically about standard credit cards. If you guys are interested or want to hear more about secured cards or charge cards, leave a comment below and maybe I can make that an article in the future. So all standard credit cards have a standard credit limit. That limit can change over time. It can get higher, it can get lower, but every standard credit card has a credit limit. A credit limit is the amount of funds a bank or a financial institution is willing to lend a borrower at any given point in time. Your credit limit is considered revolving, and thus repayment on an outstanding balance will free up some of that limit for future purchases. So for example, if you have a credit limit of $1,000 and you have spent $500, now your credit limit is only $500. If you were to pay off another $500, then you'd have access to the full $1,000 again. So it's just over time, the balance can go up, the balance can go down, but over time that credit limit will stay the same unless you actually get an increase in your credit limit from the bank or they decide to lower your credit limit based on varying factors. And so wrapping up credit limits, the entire credit limit can be used for purchases or cash advances, but it must be paid back in full over time. And at the most highest terms, your credit limit is determined by not only your current credit standing, your credit worthiness, which includes your credit score, but also your income and your ability to pay back the outstanding balance. So one of the next and most important attributes associated to credit cards is the interest rate. A credit card's interest rate is the amount of money charged for the privilege of actually borrowing money from that bank or financial institution. Interest rates can range from the low digits to upwards of 25 to 30%. Depending on the financial institution, the interest can be calculated on a daily basis or it can be calculated on a monthly basis. And this is all based on your outstanding statement balance, and we'll get into that a little bit later. Your credit card interest rate is specifically based on your credit worthiness, but the lender can also have some other preferences that go into determining what your interest rate is, and it's all based off of their internal practices. So you may think that your interest rate is just one interest rate for your entire card, but your credit card can have a couple different types of interest rates. Off the top, we have a standard interest rate. That's going to be a set rate at the beginning, but it can be variable over time. Then you may have an intro interest rate, which means that it's usually set at around 0% for, let's say, 1 year or 15 months. So throughout that entire period, depending on the financial institution, all purchases or, let's say, balance transfers or cash advances are interest free. So those are good options if you're looking to consolidate debt and you maybe want to have an alternative to getting another loan or something like that that has a higher interest rate. The last type of interest rate is going to be the interest rate charged towards cash advances, and that's when you go to the ATM and you take money out, or you use a cashier's check that's coming from your credit card to pay for a purchase or something like that. Usually they charge a higher interest rate anytime you actually do a certain type of cash advance. So I would definitely recommend trying to stay away from that, because let's say if your interest rate was set on an average 20%, that cash advance interest rate could be upwards of 25 to 30%. So definitely don't want to do that, because you'll be paying way more than you need to just to access money for a shorter period of time. So the next thing we'll get into are the fees associated with owning a credit card. So there's a couple different types of fees that you may run into based off of the type of card you have. The first of which is an annual fee. Some higher end cards or lower end cards usually charge a fee, and that's to go towards perks that they offer, or to just balance out their risk over time. So like I said, that's usually in the higher tier card, something like an American Express card, or a lower tier card, like a secured card, where you actually have to pay to use that, for the privilege to use that card over time. There's also late payment fees. Usually these are charged, it's usually based off of your lender, but the day after, if you don't make at least the minimum payment for that particular statement or month, then you're going to have to pay a late fee. And late fees can be from, let's say, $20 to $35 to $40, depending on the financial institution. You never want to pay that, so always, I would say, try to make that minimum payment on whatever your statement balance is. And the last type of fee that you might incur when using a credit card is a foreign transaction fee. Usually when you travel overseas, you can still use your Visa, MasterCard, or Amex, but you will be charged some type of fee depending on what local currency you're actually using. So if you're out of the States, make sure you try to use a card that doesn't incur those fees. I would say the American Express is a great card for that, because anytime you swipe and you're overseas, they will not charge you anything to use it outside of the United States. But let's say if you have a different card, they may charge you a fee on top of what you're already paying in terms of a foreign currency translation in order to use that credit card. So now that you know about fees, you know about the interest rates, and you know about the different types of cards, we're going to go into some things that you're actually going to see on your statement to help you get a little bit more familiar with credit cards. So one of the first couple things you're going to see when you actually get that first statement is going to be two things: statement balance versus an outstanding balance. Your statement balance is going to be as of a particular day, usually at the end of the month, or let's say the 15th of the month. Whenever you have that cutoff date, that's when they actually give you a statement balance. Statement balance is as of a certain day, and they take that balance and they put it on your statement. The next thing you'll see is a current outstanding balance, and that's as of a point in time. This is usually the same things you see in your app, or if you were to log in online, you could see your outstanding balance. And this is up until today, or however long it takes to process those transactions that you may have pending. And so let's say if your cutoff date is the 15th, and you had a statement balance of $1,000, but a couple days later you spent let's say $200. Then when you were to log into your statement online, you would see an outstanding balance of $200 above whatever that statement balance was. And then if you were to look at your credit card statement, you wouldn't see that additional 200 until the next month, and the next month's statement is received. A couple other things that you're going to see on this statement is your minimum payments, and this is going to be due for that period. If you have a standard credit card, you usually only are required to pay a tiny fraction of what your actual statement balance is. So let's say your statement balance was $1,000. Your minimum payments will usually be around, let's say, $25 to $30. So they're definitely allowing you to spend more and more and pay it off over a longer period of time, because for them, you're giving them interest payments over that longer period of time. So essentially, you're not going to be paying that $1,000. It's going to be more like $1,500 over the long run, if you decide to pay only the minimum payment over that particular time, point of time. The next thing you'll see is dates. There's two different things, like I was saying, a statement closing date, and that can be whatever date that they decide, or whatever date that you decide, and that's going to determine your statement balance. And then the last thing is going to be your payment due date. And so you're not going to be required to actually pay the minimum balance or an additional balance on the day that your statement closes, but it's usually going to be 2 to 3 weeks after the fact is going to be your set due date. So usually in total, from the time you make a purchase to the time you actually are required to pay either all of it off or a portion of it off, is usually going to be around 30 to 45 days. So like I was saying, this is more like a short-term loan with the option for standard cards to carry the balance out over a longer period of time. One of the most important factors of obtaining a credit card and a favorable rate and a high credit limit is your credit worthiness. So I won't go into detail about that too much, because I created a video specifically around what is a credit score and how that can help you build your credit over time. So I'm going to link to that up there if you want to go check that out, about how to build your credit, finding out what credit is. But for the most part, when you're going in to get a credit card, the things that the lenders look at are going to be your credit score, your overall income, your debt to income ratio, other limits that you have with other institutions or that institution as well, and your past history. If you have a mortgage and you're able to pay it on time, if you've had a car payment and you're able to pay that on time, or if, let's say, you've had a different credit card in the past and you weren't able to pay it. They're going to be looking at all that to determine, for one, if they should give you the card in the first place, and two, what your limit would be, and lastly would be what would be your interest rate on that particular card. So that was all of the boring things that go into credit cards. I would say they do allow you to actually make purchases before you have the cash, or if you just want to leverage it. Some people actually like to leverage it for the perks and the benefits associated to credit cards. So I'll dive into that a little bit. I won't go into detail about it, but maybe if you guys want to see a video about the credit card perks associated with different types of credit cards, leave a comment below. Let me know what your questions are. Maybe I'll write a video or write an article about it and make a video as well. So some of the different types of perks at a high level are cashback, based off of a percentage of the amount of purchases you make over time. Points, which are good if you actually want to use those points for not only cashback or travel. And then the last one would be travel miles. So if a company partners with an airline or a hotel, you can be able to use that those points for, let's say, free nights at a particular hotel, or for flights to a vacation. So, like I said, I won't talk about the perks too much, but there's a whole different side of maximizing credit cards and dealing with the perks. Like I said, if you guys want to see a video about that, let me know in the comments below. And so now, a lot of people won't talk about some of the other considerations, but this is becoming financially fit, and I want to give you guys the full scoop. So having a credit card does take an effect on your credit if you use it wisely and you keep your outstanding, let's say, statement balance under 30%. That goes into your utilization of your credit limit. That's always looked at very favorably for your credit score. Over time, if you actually want to get bigger, if you want to use the card for more purchases, you want more spending power, you can get a credit limit increase. So a lot of people with new credit or poor credit, they'll start out at a credit limit of $500 to $1,000, sometimes maybe $5,000. But over the course of time, if they can prove to the lender that they're responsible, that they can keep up with those payments over time, then they'll increase your limit to, let's say, $10,000, $25,000. And I've seen limits upwards to $50,000 based off of a couple of the factors that we talked about above: your income, your credit score, and your past history with that particular lender. Also, I would say that you should try to avoid at all costs cash advances associated with credit cards, because you're going to be paying way too much money, and you should never try to utilize cash advances with a card. That should be your last option. Definitely last option. And one last thing would be balance transfers. Balance transfers allow you to take the balance from one credit card and shift it over to another. So like I was saying, if you're able to take advantage of those 0% intro rates, then a balance transfer would be a great option. But if you don't get an intro rate and you'd be paying essentially the same type of rate on a new credit card, try not to transfer that balance. I would recommend just simply doing as much as you can to pay off that original balance and closing out that card if you can. So overall, guys, credit cards are a great way to help you build credit and get discounts if you use them responsibly. Some words of advice would be to try not to overextend yourself when using your credit cards. Like I said, stay under that 30% utilization range between what your outstanding balance is, your statement balance, and your overall credit limit. And always pay in cash if you can, or if you're utilizing the credit card, always pay down the entire balance every month if you can. Because if you rely on credit, you're gonna be using that as a crutch in the future. So I would say use credit for your benefit. Use credit cards for your benefit. Use them to build your credit. Use them to get discounts. Use them for the perks. But make sure at the end of the day, you use them wisely so you can become financially fit. So guys, I hope you like this video. What I'm going to try to do going forward is make at least one video a week and one article a week, and post it over on thefinancialliteracy.com for you guys to just give you some insights about becoming financially fit, personal finance, saving, investing, and a couple other things like that. So if you like this video, give me a like, and also don't forget to subscribe to the channel so you can be updated anytime I post new content. But until next week, I will see you guys later. Peace.